What is going on, Lucid fans? Welcome back to Financial Journey. So I've done my fair share of Lucid videos, I'm sure you guys are aware of that, on which even in many cases I did defend Lucid as far as bankruptcy. And a lot of people, more specifically Tesla fans, love to say that Lucid is going to go bankrupt. So I want to break it down and go over the latest video by 𝗪𝗧𝗡𝗏. And for those of you that watch my channel, you know, in general, I don't speak very highly of him, but he does talk on and compares Tesla, Rivian, and Lucid. And more specifically on how Rivian and Lucid are heading down a trajectory that is going to cause them to file bankruptcy. So I want to break it down. I'm going to skip all this 17 minutes of his video and give you the shortened version of only Lucid relevant kind of stuff. I'm going to play the beginning part just so you guys understand where he's coming from and what he's talking on. At the end of the video, I'm going to go over Mike Cole's notes on things that he does not factor in. So I'm going to go over all the fun stuff. Make sure you guys hit that thumbs up and subscribe. Always greatly appreciated. And with that, let's get right to it. So I'm going to mute myself just so you guys don't hear me. And like I said, I'm going to have chapters at the very bottom so you can just skip right to the end or whatever you want to do.
Is it possible that Rivian and Lucid, the EV auto manufacturers looking to compete with Tesla, could end up going bankrupt? In this video, inspired by a comment from Elon Musk, we're going to go through the financials of both Rivian and Lucid, and we're going to compare them to Tesla when Tesla was at a similar stage of production. And the results are quite shocking. So shocking, in fact, that it is not a surprise that Mr. Elon Musk himself provides a warning for these two companies. Here it is.
Unless something changes significantly with Rivian and Lucid, they will both go bankrupt. They're tracking to bankruptcy.
Shout out to the Velocity channel for pointing out this clip here, but let's go ahead and break down some of the financial differences between these companies and where Tesla was at similar levels of production. And again, the results are quite shocking. Keep in mind, we've got coupon code PP expiring this Friday when I go access to Elite Hustler live streams that begin next month. Okay, so first we're going to go ahead and look at Rivian. So in Q3 2022, Rivian ended up producing 7,363 vehicles and delivering about 6,584 of them. What I'd like to do to set the stage is look at when Tesla was similar to delivering around 6,500 vehicles, and I found this quarter here where Tesla delivered roughly about 1,000 more vehicles, but puts them, I would say, close enough. Puts them at 7,785 delivered vehicles 8 years ago. So Tesla was roughly at Rivian's position 8 years ago. However, their actual underlying fundamentals are in drastically different places. So the first thing that we have to understand is on the income statement. So I'm going to draw this out very, very simply first. First, you have to remember this, that if you make $100 of revenue, come on, Mr. iPad, there we go. If you make $100 of revenue, you have to subtract from that something known as your COGS, your cost of goods sold. And if it costs you $80 to produce that $100 in revenue, then you're left with $20. This is your gross profit. And this gross profit is very important. You can also call this a gross profit margin. In this case, the gross profit margin would be 20%, or 20 divided by 100. So that's what's left over divided by what your revenue was, right? After this, of course, come things like the operating expenses, and then you have things like taxes and interest and depreciation, and those things come off after that. And that's how you'll get your EBITDA and your net income. But those aren't things that we're really going to pay attention to right now. We're just going to focus on what was this margin for Tesla, and how does that compare to the margin for Rivian and Lucid at similar stages of production. And again, the results are mind-blowing. So let's start with Tesla. Now, I've already gone ahead and done the math for you, but go through this transition with me. In the 9 months ending September 30th, 2013, Tesla's gross margin was 21.3%. All you do is take this number here, divide it by this number, and subtract 1 and make it positive. In the case of Lucid, we have 2,282 vehicles produced, on track for 6,000 to 7,000 vehicles of annual production. So to get a similar quarter for Tesla, we're going to compare to the last quarter of 2012. That would be, at this point, that's looking at 10 years ago. We've got 2,400 vehicles sold, 2,750 built in the last quarter of 2012. So roughly similar for Tesla about 10 years ago compared to where Lucid is today. And when we go ahead and look at the financials for Tesla, this is now 2 years before that 2014 math we were doing. What do we notice over here? Whoa, look at this. Tesla's automotive sales are actually greater than their cost of revenues even 2 years earlier. So even 2 years earlier, they still had a gross profit. Now it's small, right? It's much smaller, 278.7 divided by 294.3 minus 1 puts them at a gross profit of about 5.3%. So it's super small. And if you take out tax credits for that, you might be closer to 0. But at least they were close to a break even, right? Where's Lucid around the similar level of production now? Well, let's take a look. Here's Lucid, folks. Lucid revenue, almost $200 million in revenue at 195. And what's the cost of revenue? Oh dear Lord, 2.5 times their revenue. In other words, for every $2.52 Lucid stuck in the vending machine, they got $1 out, and then they ended up spending another $213 million on research and development and $176 million on SG&A. This is bad. These companies are nowhere close to gross profitability, and this is a very dangerous path for these companies to be on. This is why Elon Musk is basically begging these companies, figure out how to control your costs, otherwise you're going to go bankrupt. Let's look at the balance sheets for these companies compared to cash flows. When we look at the cash flow for the last 9 months for Lucid, we're down $1.57 billion on cash flow over the last 9 months. They invested another $800 million into plant, property, and equipment. That puts their total free cash flow at negative $2.361 billion. If we now look for their balance sheet, we can go ahead and see how much time does this company have left before they either have to get loans or dilute shareholders, or should I say more loans, or by either raising bonds or taking out loans or getting new investments, which is diluting shareholders, whatever it may be. Well, they've got about $1.2 billion here in cash. They've got short-term investments of about $2 billion. We've got inventory I generally don't count. So we're gonna go with about 3.2 Kevin asset style. This is just super fast, quick math, right? We're gonna look at liabilities that we have here. We've got long-term debt of about $2 billion, finance lease liabilities. I'm not gonna take that against them given I didn't account for inventories. So we've got $2 billion of long-term debts already. That's okay, let's just assume we'll pay for that as part of our interest payoff. We've got about $3.2 billion of hard cash that we can spend. How much time does that give us if we have a cash burn of $2.36 billion? Well, it gives us probably about a year. That means by September of next year, Lucid either needs to be producing cash flow, which they probably won't, or they're going to have to raise more money, which means the share price is probably going to get hurt, or they'll have to prove some form of path to profitability that people believe in. Let's look at Rivian's balance sheet. So we jump on over to Rivian. Both of these companies are on a very bad trajectory with cash flow management. We need to see over the next 6 months a dramatic turnaround in their operating efficiency and their gross profit margins. That means cut R&D, cut SG&A, and get your freaking gross profit margins in line. Because if you can't do that, you're going to end up burning the rest of the cash you have, and you will either borrow more until your stock goes to $1, or you'll have to go bankrupt, and somebody else will have to pick up your IP. Maybe Ford will pick up the Rivian IP, maybe Mercedes will pick up the Lucid IP for pennies on the dollar, and there you go. Bad situation to be in. So, is it understandable that these companies have absolutely terrible risk, especially compared to where Tesla was in the early days? Absolutely. This is why Tesla's valued at what it is. They understand production, they understand manufacturing, and they understand profit margin. You want to invest in businesses that have high pricing power. High pricing power means high profit margin, an ability to grow and maintain margins, improve margins, and in difficult times, maintain margins. We're going into a recession, and these companies are in a terrible position. I would be very cautious with these investments. Just like I cautioned against Rivian when it was over $150. Just type into YouTube, Meet Kevin, Rivian. Thanks for watching.
Okay, so obviously you probably understand why I do not like him. He's very, very biased towards Tesla. For instance, when he did compare Tesla and Lucid, definitely he's very much biased on Tesla. The fact that he used 2012 only because of the production numbers, Lucid is in its first year of production. So this is where I come into play, and I say, on a comparison basis, we are completely blowing Tesla out of the water. They did not achieve our actual delivery numbers until their third year of production. So I love the fact that he's using 2012 versus not their first year of production. And it is very interesting the fact that he's comparing Tesla, this company that's been around since I think 2009, that's when they started doing actual production, while they're comparing both Rivian and Lucid, which are first year production companies. It does not make any damn sense, especially Lucid. We are building our own facility. Rivian, in their case, they took over a pre-existing facility, but they are adding another line, which is still very costly. But both companies are taking on a lot of risks and a lot of costs associated to expanding. And I think on a comparison level, Lucid, I'm not so much familiar with Rivian's financials and various things, but based on Lucid and Tesla, it is a complete no-brainer that we are far exceeding Tesla. And it's funny, Tesla's been around for, even he wants to say 10 years or whatever it might be. We have better technology. So not a big fan of Meet Kevin by any means at all. And clearly based on him, he's saying that we're going to need to dilute. Well, clearly he doesn't follow the stock, because we just recently did dilute 1.5 billion. So our recent issuance. And even outside of that, Peter did say in a recent interview that we are going to need a lot of money, more specifically billions. And I think coming from an investor standpoint, for those of us that do realize that Lucid is a long-term investment, definitely we need this capital. I don't think that's been any mystery. I've been saying that quite a lot in a lot of the videos, that potentially we need a lot of money. We need a lot of money, but in the grand scheme of things, coming from an investor standpoint, if for instance Lucid was not able to launch the Gravity because of lack of funding, do you think us as investors would sit back and say, yeah, that's all right? No, of course not. We need money, and we need money to launch all these big plans, more specifically even expansion. I did a video a couple days back on Lucid's expansion into Europe, and that is going to be a very, very big deal. So I completely disagree with what Meet Kevin did say. I do agree though that we are potentially burning quite a lot of money and that we do need money, which will result in a little bit more dilution, but that is just short-term pains. Keep in mind, in 10 years from now, if we're going to be comparing Lucid, where we are 10 years from now, to, for instance, now equivalently of Tesla, we're going to be blowing them out of the water. And one thing that we have that Tesla doesn't have that will restrict us from being sold to Mercedes, as he says, for 10 cents on the dollar, is we have the PIF. We have the PIF that has already given us a huge amount of money. Even I believe it is 3.4 or 3.7 billion in incentives just for the Saudi factory to be built. So imagine if we potentially need money in 2024 to launch the Gravity. Well, guess what? They're going to be like, here, take our money. Similar to what they did, I believe is 915 million of the recent issuance. They just said, sure, whatever, we will buy more. We believe in the company. So again, I completely disagree with Meet Kevin, and on a comparison basis, if you are to look at Tesla on the first year of production, I think they only did 2,000 vehicles overall. So we are blowing Tesla out of the water. And even right now, if you want to compare it right now, our production is clearly nowhere near Tesla's, but our technology and the huge amount of investors that is in Tesla versus Lucid, we blow them out of the water in both of those aspects. So let me know your thoughts on all that in the comments below. If you haven't already, hit that thumbs up and subscribe is always greatly appreciated. If you do like my channel, want to support the growth, take a look at my memberships, link in the description below, or just hit the join button at the bottom of the screen. With that said, appreciate you guys watching. Let's all make a lot of money on Lucid.